this unsettled market and those key earnings reports that are looming. Let's bring in our panel now. Joe Terranova, Chief Market Strategist with Virtus Investment Partners. Malcolm Ethridge is with CIC Wealth, and the star analyst Mark Mahaney of Evercore ISI. It's good to have everybody with us. Mark, I'm going to hit this market first, so bear with me for a second because we're in the midst of, Joe, what is a pretty sizable sell-off and a dramatic reversal from, it seems, how we felt not 24 hours ago.
A very dramatic reversal that was led by a reversal in the Russell 2000 index. I was there, I was watching it, I was trading it, and I saw the reversal after Chairman Powell spoke. The mean reversion trade for small caps relative to mid caps and large caps and mega caps, it's over. It's over. The remainder of the year, I've been skeptical about the ability for small caps to outperform their equity cap size brother and sister for the remainder of the year, and I truly believe that's over. Look, everyone's going to come on the network in the next couple of days in the midst of this correction. They're going to say, this is normal, this is the ordinary, everything's going to be fine. I'm going to echo that same sentiment. On the other side of this, we're going to be fine. But I think what the viewers have to understand is this is the month of August. The month of August and the month of September are the two worst months in a calendar year of the last 15 years. So the real message is elevated volatility is going to be present during these 2 months, and investors just have to be prepared for that environment and risk-off days. And today's a classic risk-off day.
You didn't say anything about the economy. I mean, this is not about the Russell. This is about economic data. Hold on.
Yep.
About economic data that was weak. Mm-hmm. Obviously, the Russell's going to be more sensitive to that.
Yep.
Bond yields are falling, as I said, below 4% for the first time since February. That's the story. Bad data is bad. There are serious questions as to whether the economy is weaker than people think, including the Fed chair, who talked yesterday about just being a normalization. There are pockets of weakness here and there, but nothing to be too alarmed about. That's what this is about.
So the other day, we talked about it on halftime, the fact that the economy was weakening and that we saw, I remember sitting here with you, we said, oh, we've got a 10-year treasury at a 4-month low at 4.1%. And I said, well, why isn't that Russell 2000 rallying in the face of that? And it's exactly the reason that you are underscoring. It is the fact that the economy is weakening, and Chairman Powell did nothing to assuage the concerns that investors have surrounding that. I'm troubled. I'm troubled about tomorrow.
What do you mean he did nothing to assuage the concerns? I just said what he said.
So he should have signaled that they are going to cut rates. He should have been firm in signaling that. He should have said to the market, we are going to begin cutting rates in September the same way he did in November of 2021. He said we're going to raise rates. He hinted around it. He hinted around the edges. Just come out and say it. Just say it.
He said
we are going to raise rates.
He said
we are going to lower rates.
He said cuts are on the table, and he said it about 20 times. When he was asked. I don't think anybody left yesterday's news conference confused about what's on the table in September.
I agree, Scott. I think Chair Powell did everything he possibly could to say September is on the way. And I think that really what we saw was a Fed chair that did everything he possibly could to have his cake and eat it too. He wanted to make sure that the Fed looks and stays apolitical, but also make sure that he did what he could to tip his hand in advance and let us know that cuts are coming, and do what you will with that information. But those cuts will be coming in September.
You want to redo on that? I mean,
no,
he was as explicit as a Fed chair could ever be.
Let me ask you a question. Tomorrow, if the unemployment rate comes out at 4.2 or 4.3%, now we have to wait until September to do what he should have done yesterday. The labor market should be the focus, not the inflation. He
said that.
Okay, he said that. We've gone from 3.7 towards 4.1. We're potentially going to go 4.2 or 4.3. I'm concerned tomorrow if you have a bad unemployment report. Josh said it today. Bad news is bad for the market. The market tomorrow on a bad unemployment report is not going to look good on a Friday.
I mean, he talked about the balance of risk changing, right? It used to be about fighting inflation. Now he's got a much greater confidence that inflation's coming back towards target. It is now essentially all about the labor market.
I'm not sitting here trying to place all the blame for the sell-off today on Chairman Powell. I'm just saying I would have liked him to have been more confident and direct. There was no reason not to be, and just say in September, 25 basis point cut is coming. It's warranted. We see the deterioration in labor conditions.
He's never going to sit there and say we're cutting 25 basis points in September.
In November of 2021, he said we're going to start raising rates. He can clearly signal that. Listen, I don't want to place the blame on him because you're right. This sell-off is about the fact that the economy is not as strong as many people have suggested that it is. And the signs for that have been in place for the last several months. It's been in place when you listen to a lot of the earnings reports and when you hear the commentary, in particular from CFOs.
I don't know. Shake Shack's up like 20% today. Consumers are spending somewhere. It's not every subsector of the consumer picture.
We're not headed towards a recession, but we don't need to be in such restrictive territory for monetary policy. You don't need the Fed funds rate at 5.5% when you're beginning to see a much better environment than the Fed was adversarial.
So Jeffrey
for.
Gundlach with us yesterday when Powell finished, when Chair Powell finished, kind of agrees with you. He said they should have cut yesterday. He thinks we're going to get 150 basis points worth of cuts this year, and he agreed that he doesn't think the economy is as strong as people think. Let's listen.
When we look back at what today, and it'll be history when we look back at it a couple of years from now, I kind of believe that we will say that we were in a recession in September of 2024. If you want to make your data better, you can manipulate it by having your area of the economy do some extra hiring. And that appears to be what's happening. Government employment was on a downtrend, flattened out, and now it's been rising. So I don't think the economy is that strong.
Malcolm, should the Fed have cut yesterday?
I actually, as I said, the Fed has a real big challenge with trying to make sure that they remain apolitical, and there's already been quite a bit of chatter on the Republican side against the Fed making those cuts now because it would look like he was helping out the Democrats. And so I think he's in such a tight spot that it's really tough to criticize and say he should have cut at yesterday's meeting. But I definitely do think that the Fed should have been cutting by now. So whether it was earlier in Q1 of this year or one of the meetings leading up to yesterday, I definitely think the Fed should have been cutting. And I think that we're going to look backwards on the graph and say it wasn't September of 2024 where that recession started. It was months earlier.
All right. So we got a couple things at play here. We definitely have fears about the economy. And that's why bond yields are down. That's why stocks are down a lot. I'm looking at the NASDAQ's down 530 points right now. That's a loss of greater than 3%. So then, Joe, you tell me, with another couple major earnings reports looming in overtime, being Amazon and Apple, the growing importance that they may have today is what? Is it a fact they now carry a greater importance because of the unsettling that's been going on within mega cap tech and the tech trade overall?
Sure. I mean, when the opposing team gets up and hits a grand slam in the last inning, and you got your number 3 and 4 hitter coming up in the following inning, you want them to respond. So you're looking at Apple and Amazon reporting tonight. They're getting the benefit of the doubt in the tape today. They're down, I think, 2% each. A lot of the other mega caps are down worse than that. The NASDAQ's down over 3%. They're getting the benefit of the doubt. I believe that they should get the benefit of the doubt. I'm more excited about Amazon because I think Amazon has the ability to really deliver the type of quarter here that they haven't delivered in quite some time. Whether it's a 17% AWS growth, the 11% revenue growth, or if they're able to do what I think a lot of shareholders want them to do, which is to accelerate their share buyback plan, similar to what we've witnessed from Apple and Alphabet and others in years past. They're sitting on nearly $100 billion worth of cash. They need to increase that buyback. I'd love to see them do it tonight.
So, Mark Mahaney, thank you for your patience. Let's jump ahead here then to Amazon, because Joe's talking about 17% AWS year-on-year revenue growth. I mean, I've heard numbers closer to 20 as like a whisper number. 17 to me sounds like it would be a disappointment. Set us straight on what the expectations of investors really should be tonight.
Well, investors are going to want acceleration in AWS growth. So that bogey is somewhere like 18, 19%. It may have been 19 prior to Azure and Microsoft. So it's somewhere in the 18 to 19% range. But people want acceleration, and they'd want Amazon to talk about growing demand driven by Gen AI workloads in the back half of the year, like Microsoft talked about. And then they're going to want this double-digit, 10% plus retail revenue growth. And then they're going to want rising operating margins, which they should be able to get. And I'm talking about, clipping above the $14 billion high end of their operating income guidance range. And I think they'll be able to do that. I think fundamentals are actually in a very good position for Amazon. It'd be wonderful if they came out and started, aggressively buying back stock. I don't think that's going to happen. That's a great catalyst. It's a capital allocation catalyst, but I think that's still a year or two away for Amazon. I think the setup is good for Amazon. I like Amazon as a long, and I like it going into the print tonight.
We're talking about, capital expenditures. All roads lead to AI. That's been the most central question for all of these mega caps that have been reporting, as you know, Mark. It's been how much are you spending on AI and what is the return on investment and when can we expect the ROI to really start showing up? So in terms of what they're going to be spending, what is the street going to be tolerant of?
Well, the street's going to be tolerant of aggressively rising AI capex if there's revenue and profits to back it up. That's why Meta is trading up today, or is materially outperforming the market even with the sell-off, because they're ramping up significantly capex, but they're showing revenue growth that's just staying at premium levels, 20% from very large scale. That's impressive. So Amazon needs to show that this specifically AWS revenue growth is accelerating, and that acceleration is kind of stable to continuing in the back half of the year, and it's driven by Gen AI workloads. If they can make that pitch tonight, I think people will give them a pass on significant growth in AI-driven capex.
Okay, so Joe, I think most of our viewers, certainly crossover ones from halftime, know that you have the ETF that you rebalance.
Correct.
Quarterly, which we sort of led up to. It was going to happen now. It has. You bought Amazon, so you added Amazon. You also added Apple, but stick with me on Amazon. Why that? Why now?
The momentum came into play. The balance sheet, the return on equity, the debt to equity, we saw significant improvement in those numbers. And Mark spoke about what we've seen, the improvement in margins and the improvement in revenue growth. And all of those conditions came together really in a perfect storm for this company. I'm excited about the ownership that we have here, because when I look at all the mega caps, to me, it seems to be the one that has the most potential to see significant appreciation, because let's remember, the last several years, it really didn't keep pace with some of the other mega caps in terms of their performance.
So, Malcolm, how some have used the word perfect, so I guess I'll use it with you. I mean, does this report have to be perfect tonight?
I actually don't think it does. I think a little bit differently from Joe and Mark. Yes, AWS growth is definitely going to be important for the story here, but I think the real driver to the upside is going to be growth in the digital advertising unit. They've obviously found their stride now, incorporating those ads into Prime Video, but I think looking out for this to be the earnings call where Andy Jassy maybe starts to discuss the opportunity that exists with AI-generated advertising. That could be the real catalyst here, because those margins are even more favorable than the traditional ads, which themselves are estimated to be north of about 50%. Plus, AI would give them the ability to target those ads at the perfect right customer at the perfect right time. And so I think Amazon has the opportunity to, yes, surprise us to the upside with AWS numbers, with e-commerce numbers, all those kinds of things. But the real opportunity going forward, and I am in agreement with these two guys, that Amazon is likely to be the best performer of all the mega cap techs reporting right now, Q2 earnings. But I think a different driver is going to be the cause of that.
Mark, you take issue with anything that Malcolm suggested?
No, I think Malcolm makes a really good point about that Amazon has started to, and this may be one of the drag factors for other companies like Google. Amazon is really lighting up that inventory around Amazon Prime Video, and Amazon's huge advantage in the advertising race is that they can completely close the circle. They can close the loop because the sale ends on Amazon, whereas if you're shopping around on Meta or on Google, the sale ends somewhere else. So Amazon's always had this advantage, and to the extent that they can use AI as well, Meta is the classic example of how well somebody can use AI to really improve targeting. And if Amazon can prove that they have Meta levels of advertising targeting and campaign management and ad creative capabilities because of AI, yeah, I think it's a really interesting new part of the long thesis. I think Malcolm nailed it.
So you're not concerned at all about AWS growth when you see that Azure from Microsoft missed its estimates? Does that give you any kind of pause going into tonight, or no?
Well, it did when I first saw the Azure results, and then I listened to Microsoft, and it sounded like there was a capacity constraint issue, not a demand issue, and they seemed confident about growth in the back half of the year. So I'm assuming that we're going to hear that from Amazon. Look, if Amazon prints, you mentioned this earlier, and Joe put up this bogey earlier about this 17%. I think 17% would be a disappointment to the market. I mean, if there's one thing that's going to really, if there's one thing that's going to really tank Amazon shares here, it's a disappointing AWS number. I don't think we'll get that, but you know, if tomorrow we're talking about Amazon down 10%, AWS came in at 16 or 17%, you'd see massive selling.
That's why I threw out the 20% number, because when you have stocks that have done what, and you take out the most recent weeks, I get that they've pulled back, but when you've had stocks that are still up 20+% year to date, the bar then theoretically is higher. So you have to beat whatever those thought of numbers are. We're going to see. Mark, I'm going to let you run. I appreciate your help on this. That's Mark Mahaney, Evercore. I do want to hit Apple quickly with these two gentlemen here before I let you run. You concerned going in? I mean, got to find out that China, is it bottoming? Number one. Well, not number one. I mean, that's certainly a central question. Number one is iPhone 16. Give us an idea of where demand is.
Give us an idea where demand is. By the way, first of all, let's return to growth. I think that's important. It's one of the reasons why it was added to the ETF. The expectation this quarter, it is going to have a return to growth. But I do think it's about what is the consumer going to be able to utilize for functionality related to artificial intelligence in future phones. And will it look like that in the iPhone 16? Will it have capabilities? Will the consumer have the first product in their hands that's tangible to them regarding everything they've heard about the excitement of AI? I think that overwhelms everything. And I think if they fail on that message, then you're going to see some disappointment surrounding the stock. I'm not as excited about Apple as I am Amazon. It doesn't mean that I'm pessimistic going into the report. I'm somewhat apathetic towards the direction that ultimately it's going to move. A return, if numbers are strong in China, that's okay. But if you don't tell me something really good about AI and the phone, that's where we're going to have a problem.
Well, not only that, it's this is one of those quarters, Malcolm, where it's never a non-event. Apple is always a big event, but you're only going to get so much because it's the September quarter, of course, where you start to hear more about the phone and the upgrade cycle, and that's where all of the money is riding on.
I agree with you guys, Scott, but I definitely think Q2 is going to be a bit of a yawn. But I do think this is the place where Apple shares look to take off. I've had to actually change my tune on Apple a little bit since the announcement of Apple Intelligence, simply because I've gotten a chance to learn about the different ways in which they might be able to monetize the technology in the near future. Being able to call up an email using a voice assistant from your watch and then interact with ChatGPT to craft a response. Consumers may be willing to pay up for that service, which obviously would go a considerable way to diversifying the revenue mix away from just the iPhone. And so I definitely think this is a pivotal place for Apple, but I also expect them to show up and prove it in the September quarter, to your point. And so this maybe is the place where you want to be getting in, because the shares likely don't have a downside from here. It's all positive once we do get that upgrade to the iPhone.
Yeah, you've already gotten the pullback, too, in the month of July. You want to say what quickly?
So you mentioned earlier in the conversation about consumer spending and Shake Shack. I think these two companies tonight maybe provide the best insight towards true consumer spending. Certainly in the case of Amazon, that's clear.
All right. We'll leave it there for now. Joe, you're going to hang around. Malcolm, I appreciate you. We'll talk to you soon, okay?